All right, let's just jump right in. Today, February 9th, 2026, we saw an absolute spectacle across global markets. I mean, just explosive moves. But here's the thing. When you look under the hood, past all the green numbers, the quantitative models and some classic economic theories are painting a much more complicated picture. So in this explainer, we're going to break it all down. What just happened, why it happened, and most importantly, what the data is telling us might be just around the corner. This quote really hits the nail on the head for what's happening right now. It feels like the market is in this grand, beautiful waltz, right? Everything is moving in sync, just pure investor optimism. But every dance has to end. And for any of us in the market, the billion-dollar question is always the same. How close are we to the music stopping? So here's how we're going to tackle this. First, we'll hit the numbers from today's massive rally. Then we'll dig into what's actually fueling it. After that, we'll look at a few warnings from the experts, check out the forecast for the next few weeks, and wrap it up with a Quant's strategic blueprint for what's coming. Okay, Section 1, today's market, an explosive rally. Let's take a snapshot of the global surge we saw today, February 9th, 2026. Okay, let's look at the U.S. picture, because this is really interesting. You see a major split here. The Dow Jones, the big old-school industrial companies, it was basically flat, barely moved. But then you look over at the tech-heavy NASDAQ, up almost 0.8%. And whoa, look at the semiconductor index, the SOX, up a massive 1.42%. This is a huge clue. It tells us the rally is being driven by a very narrow slice of the market, tech and AI, while everyone else is kind of just standing still. And keep an eye on that weaker dollar. That's going to be important later. Now, let's hop over to Europe. They had a strong day too, but just like in the US, there was one clear winner. Germany's DAX was the absolute star of the show, blasting right through the 25,000-point mark for the first time in history, a huge psychological level. That industrial strength really pulled up the rest of Europe, though. You can see the UK's FTSE was lagging a bit, maybe some jitters there. But the real fireworks today, they were absolutely in Asia. I mean, just look at these numbers. They are absolutely stunning. South Korea's Kospi, up 4.1% in one day. A move like that is practically unheard of. It's historic. This is a signal that a massive tidal wave of cash and pure optimism is just flooding into the region. And you could see China and Hong Kong were right there with their own huge gains as well. So what in the world is fueling this global surge? I mean, a rally this big and this widespread doesn't just come out of nowhere, right? We've pinpointed 3 key drivers behind this rally. Let's get into them. So check out how these 3 things are all working together. First, you've got the OBB effect in the US. The One Big Beautiful Bill Act is just flooding the system with liquidity, with cash. At the exact same time, you have this AI supercycle kicking back into gear. Money is rushing back into the big tech hardware leaders, which explains that huge jump in the SOX index. And then, the spark that lit the fire in Asia, the Takaichi effect. A huge election win for Prime Minister Takaichi in Japan basically signaled to the entire region that the stimulus taps are wide open. It was like a starting gun for a risk-on frenzy. Any one of these things on its own would be a big deal for the market. But all 3 at once, that's not a wave. That's a tsunami. Okay, so the party is clearly raging. But while everyone is celebrating, some of the sharpest minds in market history and our own quant models are starting to flash some pretty serious warning signs. Are there cracks appearing just beneath this euphoric surface? This is where things get really interesting. First up, let's talk about a really cool concept called sociomics. It kind of flips the script on how we think about markets. The core idea is that the news doesn't drive the market. It's the other way around. The collective social mood, the general feeling of optimism or pessimism in society, that's what drives the market. And it even drives the news itself. When we feel good, we get bull markets. When we feel bad, well, you get the opposite. And today's 4.1% explosion in the Kospi, well, according to John Costi's work in this area, that's a textbook sign of collective euphoria. It's not just a good day in the market, it's a potential peak in the social mood. It's that moment when everyone believes things can only go up. And if you look at history, it's at these exact moments of extreme collective belief that major trends tend to turn on a dime. All right, here's warning sign number 2. This comes from the legendary Ken Fisher, and he calls it the plateau pattern. This is a classic sign of a late-stage bull market. It's when, on the surface, everything looks great because a handful of giant mega-cap stocks are still pushing higher. But if you look underneath, most of the other stocks are actually starting to weaken or fall. The market's leadership gets incredibly narrow. Does that sound familiar? I mean, just think back to the US numbers we saw. This is the plateau pattern playing out in real time. You have the broad Dow index totally flat, and then you have the super narrow SOX index driven by a few AI giants just soaring. That's it. That's the classic textbook warning sign of a market that's losing its internal strength, dancing on a plateau right before a big change. And finally, let's look at what the pure math is telling us. This is a GARCH model, which is basically a quant tool for forecasting volatility. Think of it like this. Right now, the market is incredibly calm, but the model shows that this tranquility is causing a huge amount of energy to get stored up in the system, like a coiled spring. It's the classic calm before the storm scenario. This model is essentially screaming that a big explosion in volatility could be right around the corner. All right, so we've got this massive rally on one hand and some pretty serious warnings on the other. So what happens next? Let's pull all this data together and look at a forecast for the next few weeks. So our core forecast is for something we're calling a super spike. This is where the market makes one last absolutely powerful push higher, driven by that last bit of euphoria. It sucks everyone in. But right after that peak, we expect all that pent-up energy that the GARCH model is seeing to be released. And that likely means a very sharp, very sudden increase in volatility and a significant market drop. Now, here are the forecast bands for a few key indexes. But listen, the most important thing on this slide isn't the specific numbers. It's the width of the forecast band in that last column. For something like the SOX or the KOSPI, the potential swing is huge, anywhere from down over 4% to up over 4%. When a model gives you a range that wide, it's not being indecisive. It's screaming high volatility ahead. It's telling us to be ready for some really big moves in either direction. So, given that forecast, a potential final spike followed by a whole lot of chaos, how on earth do you navigate that? Let's talk through a strategic blueprint, a framework for exactly this kind of tricky market environment. Well, one classic way to play an environment like this is called the barbell strategy. The idea is simple. You avoid everything in the middle and you load up on the two extremes. So on one side of the barbell, you have 60% that's still aggressive. You want to capture that potential super spike in the hottest sectors like AI and German industrials. But on the other side, you've got 30% in super defensive stuff like short-term bonds and gold. And then that last 10%, that's your explicit hedge. Think of it like an insurance policy, VIX options or inverse ETFs that do well if things go south. It's a way to stay in the game, but also protect yourself. Okay, and I have to be crystal clear here. This is not advice. This is purely an educational example of how a quantitative system works. The whole point of a quant strategy is to take emotion out of the equation by using hard and fast rules. You have clear signals telling you when to buy, things like tricks and MACD showing momentum, and just as important, you have clear non-negotiable rules for when to sell, like an RSI crossover or most importantly, a hard stop loss. The goal is to have a system that keeps you disciplined when everyone else is either getting way too greedy or way too scared. So let's pull it all together with these lessons from the masters. Gunter Dueck is reminding us that these super efficient markets can also be super fragile. Ken Fisher is telling us we're likely dancing on a market plateau, which is the last waltz before the end. John Castee is pointing to the collective euphoria as a massive warning sign. And finally, Edward Dewey's work on cycles reminds us that, yeah, the peak is probably close, but the music hasn't actually stopped, at least not yet. And that brings us to the final and I think most important question. The music is definitely still playing. The party is in full swing, and the momentum feels like it could go on forever. But in a market that's showing all the classic signs of a final frenzy, do you know where the exits are? It's a beautiful dance, no doubt, but it's always smart to know where the doors are before the music stops.